Hi folks, and welcome to this short lecture on calculating diluted EPS when we have actual conversions on two securities, bonds and preferred shares. We've discussed before that when we have actual conversions, we have to invoke what we call the backdating concept, which means when you have conversions that happened at the beginning of the year, in order to calculate a diluted EPS amount, you have to play what if again, but in this case you're saying, what if we had converted those bonds or those preferred shares to their earliest point during the year before the conversion. So for example, let's say you had converted bonds on July the 1st. We have a January to December year. When you're calculating your diluted EPS, you would look and say, well, what if I had converted those bonds 6 months earlier, right? As opposed to when we had no actual conversions, what if we had converted those preferred shares or those bonds 12 months earlier, right? So the only thing that really differs is the period over which you're backdating. But the concept is the same. We're still applying the what-if kind of model. So now, the question here, make sure you have access to the question that's given in your online course. All right, the reference or the problem will be in your online course. And in this question, we can see that we have, to calculate our basic EPS, that's always our first step, we have $920,000 in earnings available to common. That's given. Now, we have to think about now how much of the earnings are no longer available to common because we've declared preferred shares. Now, don't forget here, it said here that these preferred shares, the dividend was payable quarterly, and from what we can see, those dividends had been paid on a regular basis. So therefore, we have to now think, it said there in one of the paragraphs that the preferred dividend was payable quarterly, and that 5,000 of the 20,000 outstanding preferred shares converted after the dividend was paid on September the 30th. So therefore, once the September 30th payment was made, we had converted 5,000 of those 20,000 preferred shares to common. So now, how is this going to affect our earnings available to common shareholders in the basic EPS calculation? Well, first of all, you know that we had been paying on the full 20,000 shares, we had been paying 50 cents a quarter for the first 3 quarters because 5,000 of these 20,000 preferreds didn't convert until after the September 30th payment, which would have been in the 4th quarter. So for the first 3 quarters, we paid a 50-cent dividend on them, right? On the 20,000 preferred shares. It's just in the last quarter, so if you go down here, maybe I'll just shrink the screen a bit. I don't know how it's going to affect your view. But you can see I'm telling you that these 3 quarters are the first 3 quarters because in those first 3 quarters, that's when you paid preferred share dividends on the full amount. Right, the full 20,000 that were out there outstanding with the preferred shareholders over the first 3 quarters. But in the last quarter, don't forget, if 5,000 converted, then you're only paying 15,000 preferred share dividends on 15,000. That's all that's left at the end of the year, and that would be 50 cents a quarter for 1 quarter, and that's the last quarter. So therefore, earnings available to common, if you go down here and add all that up, you're going to get $882,500 available. Now, when we're calculating the WACs, we have to be mindful of a few things here. First of all, in your question, it might say on December 1st there was a 3-for-1 stock dividend. That should be a stock split or a share split. So change the reference to dividend to stock dividend to stock or to share split. All right? So that's an error in the question. But in any case, if we look at the data that we're given on the top of this question, it says that on January the 1st we had 140,000 shares outstanding. But don't forget, on April the 30th, it also said that we converted $5 million in bonds to 55,000 shares. So now we have 195,000, which is the 140,000, plus the additional 55 makes it 195,000 shares outstanding. So now let's just, before we move on to these last 2 rows, let's just focus on these 2 rows here. Don't forget, these 140,000 were available from January the 1st to April the 30th. So that's January, February, March, and April. That's 4 months of 12. But if you work down to the bottom there, you can see on December the 1st, we had a 3-for-1 split. So therefore, we have to multiply all of the previous shares outstanding by 3. All right, to account for the share split. If you're not certain about this, I did post some refresher videos in your course to show you how we handle share splits and share dividends when we're calculating basic EPS. So you might want to go back and review them. Now, again, similarly, with the 55,000 new shares out there as a result of the converting the bond to shares, those guys are outstanding now for 5 months. How do I know that? Because on September the 30th, there was a preferred share conversion. We converted into common. So from May 1st all the way to September 30th, that's when I had 195,000 shares outstanding, which include the 55 from the conversion of the bond. So I had these 195,000 shares outstanding from May, June, July, August, and September. That's 5 months. 5 months, right? And again, since the share split happened on December 1st, these also get the benefit of the 3-for-1 split. And now I'm going to have 220,000 shares outstanding when? October and November. Why October? Well, don't forget, on September the 30th, we had issued 25,000 common shares when we converted the preferreds to common. So this, from going from 195 to 220, that's your additional 25,000 shares. But don't forget, we had a 3-for-1 split on December the 1st, right? So we're only counting here October and November into our calculation. And again, these don't have the split in them, so we multiply those by 3. For the last month of December, this includes the split, so we're not going to multiply it by 3 and double count it. This is for the last month of December. So now, this happens to be our weighted average common shares for the first 4 months, the next 5, the next 2, and the last. So we now have in total for our WACS calculation for our basic EPS 548,750 shares. So when we calculate our basic EPS, we're going to get $1.61 a share. So you may want to go back and review this again and perhaps even review some of the share dividend and share split questions that we posted as refreshers for you to help you calculate basic EPS. Now what we're going to do in step 2, hopefully, by the way, you've reviewed step 1 and you're feeling comfortable with that because it does have a share split and it has 2 conversions in there. So that's a nice little comprehensive question to show you how it's going to affect your basic EPS calculation. Now, let's have a look at step 2 where we're going to test each security for dilution. So now, the first thing we're going to do, it doesn't matter the order you test, but we have 2 convertible securities, preferred shares and bonds. So let's look at the preferred shares first, and let's look at the ones that we converted. The question told us that we converted 5,000 shares, right, of those preferreds. Now, on those 5,000 that we converted, how much would have been the dividend that we avoided paying if we had converted them earlier in the year, right? Well, we converted them in the after the 3rd quarter, right? So we had already paid out 50 cents per quarter in dividends for 3 quarters. So 50 cents per quarter times 3 quarters is $1.50. So if we had converted them earlier as opposed to after we had paid $1.50 or 50 cents a quarter for 3 quarters, if we had converted them earlier at the beginning of the year, we would have saved 3 quarters worth of dividends, which would have been 50 cents a quarter times 3, which would have been $1.50 a share. So the dividend we would have avoided would have been $7,500, and that would have been money that would have been available for the common shareholders, right? In fact, I'm going to do what I did last time. I'm just going to see if I can pull this out for you and paste it here. Hopefully it'll work out okay. Oh, maybe not so nice, eh? Anyway, maybe we could do it like this and just put it on top here and then do a wax Do that here, and then we can adjust later. Get rid of the table. Looks like we got a little Excel lesson going, our word lesson going on here, doesn't it? Then we'll have our wax in here and our EPS, and the world is good. All right, so now, now that we got our headings back in there, all right, now let's look at the individual effects. So now, the preferred shares, we've already talked about the dividend that avoided, which would have increased the earnings available to common by $7,500. But don't forget, those 5,000 preferred shares got converted. Each of them got converted into 5 common. It gives you that in the question. It tells you that each preferred was eligible to get 500 on or 5 common shares on the exchange. Now, don't forget, if we had converted that back to the beginning of the year, we only did the conversion after the 3rd quarter, but if we had done it 9 months, which is 3 quarters, each quarter has 3 months, 3 quarters, 9 months out of 12, and don't forget, they also get the benefit of the split, right? The share split. Because don't forget, we have to treat it as if it was converted at the beginning of the year. And all of those shares that existed at the beginning of the year would have got the benefit of the share split. So therefore, this 3 relates to the split that happened on December 1st, because all of the previous shares earlier would have got advantage of that split. So now your wax would have gone up $56,250. So your EPS here would have been $13 a share. Since it's less than your $1.61, we would say we're going to include it in your diluted EPS calculation. Similarly, for the preferred shares that were not converted, what would we have saved in dividends? Well, those 15,000 were never converted. Only 5,000 of the 20 got converted, so 15,000 is less. So if we had converted those at the beginning of the year, we would have saved 50 cents a quarter over 4 quarters, which is $2 a share, preferred share for dividends. So we would have avoided 30,000 in dividends, and that would have been available to common. How many more shares would have been out there? Well, again, you would have had 15,000 more shares, right, out there, right? But I'm multiplying it by 15. This 15 is the same as 5 common times your split, right? That's 5 common times the split, because each preferred share gets 5 common shares. So if they had converted the remaining 15,000 that were there at the end of the year, at the beginning of the year, these guys would have not only got 5 common, but they would have got advantage of the split, because don't forget, the split goes back to the beginning of the year. So therefore, we would have had an increase in wax of $2.25. So therefore, our EPS here is going to be 13 cents. It's less than the basic, so we're going to include it in our diluted EPS calculation. Now, let's have a look at the bonds. This is a little bit different for you guys, so we need to pay a little bit of attention. We know that these bonds actually got converted on April the 30th, which was 4 months earlier, right? So what was the amount of after-tax interest that was saved on the bonds? Well, I'm not sure here if they actually gave us the amount of interest expense for sure, but we can calculate that because they told us that the bonds here were 6%, right? And it also told us in the question that when they were converted, there was a remaining discount on the bonds that was unamortized of $8,333. So now, here's where you need a little lesson or a reteach on how we calculate this as our interest expense. All right? So we need to have a look at this. This is pre-tax interest expense. I separated out the tax piece because I want to focus here for a moment. You guys know that whenever you have a discount bond, how much is actually interest expense? If you go back to your bond amortization tables, you can even go back to ones that we did earlier in our course or any of your prerequisite courses. When you have a discount, your interest expense is going to be equal to 2 pieces. Your interest paid plus any amortized discount on a bond. Those are the 2 pieces. Your interest expense is equal to interest paid plus any amortized discount on your bond. So therefore, the amount of interest that we paid that we could have avoided if we had converted 4 months earlier. So instead of converting April 30th, converting 4 months earlier would have been $100,000. But that's only part of the interest expense. Don't forget, we're trying to find out earnings or income available to common, right? So we don't include just cash interest paid in there. We include interest expense. And when you have a discount bond, your interest expense is greater than your interest paid. By how much? By the amount of the discount we'd amortize. And don't forget, when you remove a bond from your books, either pre-retirement or pre-maturity date, you have to fully amortize all the bond discount, right? So you amortize that bond discount, and that bond discount shows up as part of your interest expense. So now we have pre-interest expense on the bonds of $108,333. Because the tax rate is 40%, after tax, we want to calculate the effect on net income, so we're going to say we would have avoided booking interest expense after tax of $108,000 times $108,333 times 60%, and that will give us $65,000. So now, we've got our after-tax impact, so that's the interest expense you're going to avoid after tax. How much sooner would the shares have been out there? Well, don't forget, these 55,000 shares were issued on April the 30th. But don't forget, they also get the benefit of that share split, right? Because anything that existed or was issued prior to December 1st gets the benefit of the split, right? And it's a 3-for-1 split. And if they had been converted earlier, we would have had them outstanding for 4 months, right? 4 months earlier. January, February, March, April, we would have had them out there January 1st if they had been converted earlier. That would result in 55,000 in increased shares. So the EPS impact here would be 118. We know here that our basic is 161. So therefore, we're going to include that in our diluted EPS calculation. Now, we're going to go on to step 3, and step 3 has another little nuance in it that I want to point out as we get to the end of the question. What we're going to do first off is we're going to look at calculating our diluted EPS using the Cascade worksheet. So now, we've already done this part here earlier on in the question. So if you're not confident with how we got our basic EPS, you may want to go back and replay the video for this piece, and as well go back through some of the prerequisite videos to sharpen your skills on the impact that share splits may have on your basic EPS calculation. Okay, for now what I'm going to do is I'm going to go back here and now calculate my diluted EPS. As we've been saying, we have to put the securities in the diluted EPS Cascade worksheet in order of most dilutive to least dilutive. So we know that the preferred shares, when we tested them for dilution, the impact is 13 cents a share. That is more dilutive than $1.18, so the preferred shares will go first. If we put the unconverted shares first, we remember that from our previous calculation here, the unconverted preferred shares increased income available to common shareholders if they had been converted at the beginning of the year. They also increase WACs if they had been converted. So what we're going to do now is add this to the calculation to come up with $1.18 as our diluted EPS. Now, when we look at our preferred shares that were converted, we already discussed that as well up here. We said if our preferred shares that were converted, if they had been converted 3 quarters earlier than they were, that would have increased the income available to common shareholders by $7,500, and it would have increased your WACs because we would have issued those preferred shares 3 quarters earlier. And don't forget, they're also getting the benefit of the share split, so that would have increased our WACs by $56,250. So now we would have had $1.11 as our diluted EPS. Now, here's where you have to be careful, because at this point you have a diluted EPS which is already at what I would say as low as it can go. it's already at $1.11, right? That's your diluted EPS. You'll recall that the bond had an EPS impact of $1.18. I'm now thinking I shouldn't even include that in my diluted EPS calculation because its impact individually is now going to be greater than my current diluted EPS calculation in my Cascade worksheet. I didn't know that up here. It appeared to be dilutive to me, right? I was going to include it in my diluted EPS calculation. But now when I'm going down here, I'm saying I don't think I should include this guy. And you shouldn't. All right? You shouldn't include it. All right, so now I'm not going to include it because it's anti-dilutive, because it has an EPS impact of $1.18 a share. So I'm going to leave my diluted EPS calculation here at $1.11 a share. Now, some of you might miss this fact, right? It's a new teaching, so you might miss that fact. But let's see, what if you didn't catch that fact? How would you know? How would you know that you made a mistake and you don't include it? Well, now we're going to get technical on you, because if you do this piece of math up here, which I've done here, normally we just round to 2 decimal places. But if we get fussy about it, this is not truly $1.11. It's $1.108, right? 10.8 cents, right? Now, if I included that bond in my diluted EPS calculation and mistakenly included it, what would I have done? I would have added that $65,000 after tax to the income or interest expense after tax that I would have avoided had I converted the bonds earlier, and those 55,000 new shares would have been issued, right? Those are the ones that were actually issued in April that could have been issued 4 months earlier and also got the advantage of the split. Now, if I do that math, let me see if I can just, I don't know if this is going to help you, but if I, no, it's not going to help. But if I had done that math now, I'd actually see that this works out to 1.113 as opposed to 1.108. So technically, although you don't see it with rounding, technically it is bigger. It is bigger. So therefore, I would exclude it because it's technically going to give me this EPS here, diluted, which is greater than what I had before, right? Which is this guy, right? So technically, this is giving me, the bonds are giving me an EPS that's ever so slightly bigger than the one that I've ended off with over here, right? So it may be a salient point. That's why I'm saying maybe just know the rule. If ever you have an individual security whose individual EPS impact is such that if you include it in the diluted EPS is such that the diluted EPS in the Cascade worksheet is already, so this guy here is already below 1.18, which is your EPS impact from the bond, right? Then exclude it from the diluted EPS calculation. Okay, so this video is one you might want to review again. So make sure you do. And this concludes our presentation of actual conversions in calculating diluted EPS when we have preferred shares and bonds actually converted.